Gerard, let's start with your words. Confusing, sloppy and surprising. What was confusing, sloppy and or surprising about what we've seen this morning?
John, I think what's confusing and sloppy is that nobody knows, and we're hearing this on the call with JP Morgan as we speak, nobody knows how impactful the stimulus plan has been to these very strong credit numbers we're seeing. We know that the economy is recovering, and we're not certain just yet whether the economy can stand on its own 2 feet and continue to deliver these strong credit numbers. So that's the real confusion here. And I think, granted, these are good numbers. The credit numbers are very strong, but there is a little bit of confusion on a go-forward basis on how important the second stimulus will be to the economy.
So, Gerard, are we sitting here and saying, even for the banks, their outlook right now is just dependent on whatever happens next in Washington, D.C.?
It is partly dependent upon that. Absolutely, John. I think what we have to look at is we've always pointed out that banks are products of their economy. So if the U.S. economy, as you know, is going to have some incredible growth in the third quarter, but that's more of a mathematical exercise to the second quarter. But if we start to see 2 to 4% real GDP growth in the fourth quarter and first quarter of next year, then we're going to start to see the all clear signal for the banks to be able to grow. And that is going to be the challenge for 21, is growing those top line revenues.
We heard from the IMF around about 35 minutes ago, for whatever their projections are worth, a shallower recession, but a shallower recovery through 21. I want to read you the words of Jamie Dimon 3 months ago today. Basically 3 months ago, precisely last quarter, Gerard, when he said this is not a normal recession, the recessionary part of this you're going to see down the road. You will see the effect of this recession. You're just not going to see it right away because of all the stimulus. Gerard, have we seen any of it yet?
That's John. In bank earnings, we have, because the provision for loan losses has been so elevated due to the new accounting procedures that the banks use. And so I think peak provisions are behind us. So the earnings have been definitely impacted by this recession because of the higher provisions. But the credit losses, we have not seen a material pickup as we normally would have seen if it wasn't for these stimulus programs.
So you and I would often have a conversation about loan growth, where we are sequentially, quarter on quarter, year on year. Let's talk about that, Gerard, and let's also talk about how profitable those loans are going to be. Gerard, walk me through it at the moment.
What we're going to see, John, is that the organic loan growth has been actually flat to down, and that's to be expected in a recession. What you saw in the earlier part of the year from loan growth were the government PPP loans, the Paycheck Protection Program loans, and as well as the corporate lines of credit being drawn down. The lines of credit are now being repaid. The PPP loans are being used. So the actual organic growth is going to be flat to down through the end of the year, in our view, which is very normal during a recessionary period. As the economy grows, we expect to see loan growth start to pick up. And historically, John, loan growth tends to track the nominal GDP growth number. So if we get nominal GDP growth of 4 to 5%, seeing 2 to 3% loan growth next year is not unreasonable.
Gerard, these banks are still making money. And I think the question of this morning is, where is the money going to go if the buyback plans have been suspended? I don't think the right question is to work out what the rest of the year looks like. It's to work out what 2021 looks like, Gerard, for the capital return programs of these huge names. Have you got any projections right now?
Yes, we do. As you know, John, and you pointed it out, the Fed has put in the temporary suspension of buybacks similar to what they did in the third quarter, and they've limited the dividend payments as well to the average of the prior 4-quarter earnings, which is not going to be a problem for most of the banks. But we do expect the Fed to lift that temporary order. It could be lifted as soon as the first quarter if these numbers continue to improve the way you're seeing them. So I think we're and other investors are expecting the buybacks to be restarted next year. In our models, we're putting them in the second half of the year. But if the strength of the economy continues and the numbers continue to look like what we're seeing today, I think the buybacks may start in the first part of next year rather than the second half.
Do you expect to see stronger, more aggressive cost-cutting going along with that as well, Gerard? Because quite clearly in the last few quarters, there's been a real stigma attached to doing that. And now there's a real boldness in the C-suite that I think we can all identify, where people feel a little bit more confident about making the decision to cut. Do you see the aggressive cuts?
Yes, we do, and you put your thumb on it. We've seen this in past downturns as well. So it's taking a page out of the old playbooks, and we're already seeing some of the banks announce. Fifth Third, for example, announced a major cost-cutting program about a month ago. We expect to see more of that as the banks look to improve their profitability in a slower revenue growth environment by cutting costs. And on top of that, when you take a look at the digitalization of banking, there's no need for the number of branches that the United States banking industry has today. And you're going to see more branch closures and consolidations because customers are just not using branches as much as they did 5 years ago.
And that's certainly accelerated through this pandemic, Gerard. Just a final word from you, please, sir. JP Morgan up in a pre-market by a little more than 1%. Citi up by 0.9%, 20 minutes away from the opening bell. Later in the week, we'll hear from more names. Who have you got your eye on, Gerard, specifically in a more constructive way going into reporting season?
I think everybody should keep an eye on Bank of America. You know, they are a big consumer lender. You saw the numbers today. They're very similar to a JP Morgan. And then on top of that, you need to look at Morgan Stanley. Morgan Stanley obviously is going to benefit from the strong capital markets business. So those would be two distinct names to keep an eye on. And on the regional side, we take a look at Truist. Truist is the merger between BB&T and SunTrust, and they've been putting up some good numbers, and we expect that to continue in the third quarter.